Hi everyone, my name is Z Razak from Surtax. We've got a special guest here today called Akil Mir, and he is a extraordinaire when it comes to financing. And what we're going to do going forward is talk about a few issues that we come across and how people collaborate to get solutions. Akil, tell us a bit about yourself, and thank you for coming on.
No, pleasure. Thanks for inviting me to your offices here, Z. Well, a bit of background for myself. I've been in the financial industry since 2002. Humble beginnings with Bank of Scotland. Some people may remember them for mortgage purposes. So my background is predominantly banking and finance. As I said, from 2002, various roles within Halifax and Bank of Scotland. Then I worked on the trading floor on the derivatives with Lloyds Bank in 2012. So predominantly my background, as I said, is finance and banking. But I've always loved property alongside that. So I bought my first property in 2005. And I was just shy of 21 years old, so
Wow.
Very, very early entrant into the property market. And it's always what I've loved, being Asian, you might say the same, we always love property, some things that are tangible that you can, feel and look at as well. So I've loved banking, I've loved property, and I always wanted to amalgamate that. And I thought, what's the best thing to do and how can I help people grow in terms of income producing assets? And I became a mortgage broker quite some time ago, passed the qualifications and so on. And then I set up my own brokerage called Our Mortgage Broker in 2017. We are an independent, directly authorised FCA brokerage, and we specialise in all types of mortgages and property finance. So from anybody from a first-time buyer to buy-to-let mortgages, bridging loans, development finance, and commercial finance as well. So there's lots of things that we get involved in, lots of different types of clients that we help find mortgage solutions for. But what can I say? It's a lovely market to be in. Every day is a new day. There's lots of changes in the industry. And probably like yours as well, and you've got to remain, you've got to educate yourself, and I think you're probably going to touch on it, but collaborating and working with the right power team around you, just simply because the market is extremely complex. So whether you look at the legality side, you look at the tax side, you look at the mortgage side of it, including the interest rates, it's a very topical subject at the moment, and no doubt we'll talk about that in a minute. But that's how I came about. We are a team of 8 mortgage brokers. Our main office is in Bracknell in Berkshire, so we help clients all across the United Kingdom. So whether you're buying or investing properties in England, Scotland or Wales, we're happy to help.
Thank you for the detailed introduction there. There's a lot of items there. Akil is someone that's very prominent in this field. You've probably seen him on many different podcasts and webinars. The reason why I got Akil to come and see us was I get a lot of challenges from clients as well, where we're trying to help grow their businesses, trying to help them get properties, whether they're a property investor, property developer, or even getting their own property for their own business. And I was speaking to Akil in bit detail about this. And I want to get his thoughts and insights, because the thing that people make a lot of mistakes on is that they only think about things single dimensionally. They don't think about, right, I've got a solution here. This is my account tax advisor said this. What's my finance person saying? And does it line up? And does it actually meet my long-term requirements? And I think that's the bit that I'm trying to clear up in this disconnect with Akil. And one of the things, Akil, if we can start on, is LLPs, which is a limited liability partnership. I often find when you speak to the banks directly, is that they don't actually understand these structures. We talk, there's different types of LLPs, but we're going to keep it simple and just talk like a husband and wife LLP. First of all, obviously you deal with a few of those. Is it quite easy for you guys to get financing, and what restrictions is there?
So the beauty is where we sit as mortgage brokers, we're dealing in more in the complex arena. Right. And that's the way the market is moving towards. So this is predominantly to those clients that are looking to buy properties, as you said, in an LLP or a limited company formation. What I would say is, because of Section 24, and that came about 4 or 5 years ago now, a lot of savvy, seasoned investors are taking up relevant advice from the likes of yourself about restructuring their portfolios or buying properties in an LLP formation, for example. What lenders have done previously is not working to how the market's changing, or they're slow adopters, I should say. What I would say is, because we're independent mortgage brokers, and independent is the word that you want to be using in this space, is you want to have a spectrum of lenders that we can reach out to meet the client's expectations and for their mortgage property goals. And the best way of doing that is, first and foremost, is taking up the relevant advice from the likes of the tax advisor and yourself, speaking to the mortgage brokers like ourselves, and anybody else that needs to be involved in that process, and actually making sure we're all aligned. So it's all about lining up your ducks before you sign on the dotted line. And the best way of doing that is basically being very vocal and being very proactive and speaking to the relevant people in advance of making those long-term decisions. Because the last thing you want to do is make a decision, sign on the dotted line, and then think, okay, how am I going to refinance this property? Or have I got a lender lined up? Because it might be too late. And to unravel things can be quite complex, could cost you, and it could quite take some time as well. So, I would always say, before you agree to do anything, especially if you need finance and you need mortgages, speak to the relevant people, because the market is it's very complex. There's a lot of variety out there, but the beauty is there's a lot of variety out there. The market is very liquid, and lenders are doing great things, especially in the specialist arena. So there are mortgages for LLPs, there's mortgages for limited company ownerships as well. And the other thing I wanted to touch on was borrowing funds between your two trading businesses. You can loan money between companies. They can be a gift, they can be a permanent loan, or you can return the money in a certain time, and you can charge back interest as well on those loans that you draw down. So there's various ways of doing things, but the beauty is there are options out there. And going back to your point at the beginning was, most of the high streets are not in that space. And the simple reason is because they're inundated with regular vanilla types of mortgages, and that's what they want to have on their balance sheets. That's the mortgages that they're keen to deliver on. So they've got their niches, and then the specialist arena have got their niches, and we sit in between. So we've got access to both spectrums of lenders. So we've got to remain smart in this business, I would say.
I think, Akil, you made some amazing points. I'm going to try to dissect that. You've covered a few topics. First of all, Akil's mentioned some tax aspects, which I'll touch on that. The other bit is about customizing the offering to the person's requirements. Because a lot of times I phone up, or when a client phones up, their stuff isn't vanilla. And therefore they need someone to talk it through and say, this is what you can do, this you can't do, or maybe you need to structure it this way. And that's where, Akil, you come in quite a lot. You mentioned how to finance personal leverage now into the company or into whichever structure. That changes depending on what you're doing. There is certain benefits of doing that, because yes, you can charge interest to the company. You have to structure it in the right way, and there is certain requirements around that, where the company has to sometimes hold money back because you're connected before it can pay it back to you, and then you claim it back on your self-assessment. The other bit that you mentioned is when you take loans in your own name. There's special tax advantages on that as well. I'll give a bit of a masterclass on tax here now. You can actually charge that interest to your company, provided it meets certain requirements, and therefore get relief. It basically increases your personal allowance. So you can do two different things, which Akil's mentioned there. The bit that I'm really keen on to understand is when we're doing, let's do an example, because this is when it brings all the stuff to life. I'm a bit thinking about an acquisition at the moment. Let's put that, and this uses all the different avenues. Let's say we're buying a commercial property, right? And if you come to see people like myself who understand property, and that's a bit of a specialist area, is how do you structure that? I've got a trading business, which is an accountancy practice, and I've got a property. Depending on the advantages, we may choose, and I've done other videos on why you probably may want to choose an LLP, but let's say we choose an LLP, limited liability partnership. How does that work with the company? Because the company is obviously going to lease it from the LLP.
Correct.
So they're two different structures. How would I get a financing from a commercial property? What's the things I have to think about when I'm doing that?
Okay, so there's a couple of things that you need to think about first and foremost. The first thing you need to think about is, how are you going to buy this commercial asset? If you're going to trade from there as your own trading business, let's say you've got a property that compromises of a ground floor and a first floor, and you say, you know what, I can do with just using the ground floor only. You'd occupy the trading business as your own business on ground floor. You may choose to let out the first floor to another trading business or an investment business. What you would do is understand the formation of that company that creates that owns that property tomorrow. And what you'll do is you'll have an operating company that operates that function, that'll be your ground floor business. And then you'll have a property company that actually owns the actual freehold, the fabric of the property. So you have an opco-propco structure. In terms of the lending perspective, because you might have a bit of a hybrid, you might trade from there as well as have the investment arm because you let out the first floor. We'd look at a hybrid structure in terms of the commercial debt or the commercial loan that we go for. So if this, let's assume, is a pure commercial property, it doesn't have any residential element, we'd source a lender that allows you to trade from there as well as let out the first floor. So you've got to understand who's buying the property and how much of the square footage are you acquiring versus how much the investment side is. Once we know what the splits look like, we can then contact the relevant lenders to understand, inform them of what the structure looks like, who the trading business is and what their track record is, because the loan is dependent on a couple of things. One would be the trading business's accounts, how strong they are, have they had any issues during COVID in particular? A lot of questions asked around that, especially when you are a trading business. And then the other side is, what's their experience of running that trading business, the strength of the account and the longevity of the business. The other thing is if they're going to let the first floor out, for example, what's their experience in letting out office space? Have they got experience in that space? Now, if you are, for example, if you've always run your business through a serviced offices, where all you do is pay a flat rate per month, it takes care of all the overheads, that can then go towards your experience of running and managing your own trading business in a commercial premises, because it has got a lot of clout to it, which is an advantage. With regards to the mortgage itself, it is dependent, as I said, on the strength of your account and the vacant possession value of the property. So as the property, when the bank instructs a surveyor, they'll go out and provide you with typically 3 valuations. One is vacant possession. So if it was vacant, it wasn't producing any income, how much could they sell this property for? And it's also called VP valuation. You'll also get a 90-day valuation and sometimes a 180-day valuation. And what that means is, how much is this property worth in 90-day sale period and how much would it be worth 180? Wow. So the further you go out, the valuations get less. And then you might get another 4th valuation, which is the OMV, which is the open market valuation. All day long, this is how much this property is going to be worth, and that's really the valuation that you're after, not the vacant possession, not the 180 or the 90, it's the open market valuation. So we will target the lenders that will instruct the right valuation, or more importantly, lend based on those sort of valuations. But with commercial mortgages, they're very much different to residential. You know, Halifax is 1.99, 2-year fixed, take it or leave it. Yeah. Whereas commercial mortgages are very much dependent on those variables: the length of the lease for the covenant, the vacant possession value, the strength of the trading business. There's lots of variables, and then that gets intertwined into the interest rate depending on the risk factors and how long you're amortizing that loan for. And what that might mean is some lenders may only want you to take out the loan on a capital interest basis. Some may allow you to take an interest-only loan, but that then is subject to those caveats in the background.
I want to try unpacking that huge value to the LinkedIn family who are watching this, maybe perhaps the YouTube family, and also the Surtax family who are watching all of this information that Akil's telling us, because it is complex. Commercial property is quite a big driver. One thing in our benefit is something you mentioned about the changes in landlord taxation doesn't affect commercial property. So don't you love that? So therefore it is still tax deductible even in an LLP or in your own name. So that can be a benefit. I think the bit that I want to unpack is, how do we get that it's the open market valuation, OMV, because I think that's the one people strive to, because that's tends to be the higher value. What would you have to do to try to get that valuation, so therefore you can borrow more?
The key here is that make sure your mortgage broker is going to go to the relevant lender that is going to work off the OMV value, and that would just be communication. So we as mortgage brokers will ask the client, the borrower, their expectations, what their property goals are, the formation of the company, and the income that the property is going to drive. We will then go out to the relevant lenders in that space to say, this is the formation, this is the experience and the CV of the borrowers, these are what the incomes look like, these are what the accounts look like. We'll give them a description of the property in terms of the setup, location, the address, the potential purchase price, and we'll explain to them that the client wants, if you are buying it as an investment, open market valuation. It's a bit like HMO, you want the yield valuation, you don't want just a trading business valuation. So you want a goodwill valuation. That's another thing that people call it, a goodwill valuation. So it's all about going to the right lender. It's like residential HMO mortgages. You need to go to a lender that offers you a HMO mortgage, and more importantly is going to instruct a HMO valuation, a yield valuation, a commercial valuation, whatever people want to call it nowadays. But the key here is making sure that you're you're talking to the relevant lender that's actually going to do as they say they're going to do. Look, this business is very moving. It's constantly changing, and you've got to adopt to it. But you've got to, as I keep saying, you've got to speak to the relevant lender and make sure that they are doing what you're expected to do, because what will happen is commercial mortgages do take, the application is a lot longer than a residential mortgage. So you just got to be conscious of that. It's an extra 20% more time with getting a commercial report back, underwriting that commercial report. The other thing you've got to be conscious of when you're buying commercial property, it's not just sometimes just one surveyor that goes out. You might need various surveyors to do various things, because a commercial might be in a certain floodplain area, it might have subsidence, it might have asbestos, that sort of stuff. So you've got to be very, very commercial, very, very conscious of commercial properties and what types of reports that are required. But the bank will request that on your behalf. You just got to pay the bill.
Yeah, do you know, Akil, you covered so much off there, and I'm trying to unpack some of this stuff. The question you answered in before I was able to ask the question, and that was the timing. Because when you go and buy normally property, you buy it, you get the financing pretty much done. So if it's a buy-to-let in a limited company, you normally put 25% deposit down, 75% the lender. It's done. They're used to doing loads of those. Commercial is a bit different, and we were talking off air about this. The valuation is so important here. So let's use, I'm going to use a round number. I know it might sound a big number, but £1 million, because the numbers will keep simple. If you're doing £1 million commercial property, you're probably going to have to put down, say, £300,000, probably 350,000. So it's got to be 30 to 35%. And if you're borrowing money, how long do you reckon it would take before you would get the rest of that money?
I wish I could say days, but it's certainly going to be weeks. Now, going back to the deposit, if you're buying something for £1 million, I would say a 35% deposit is a very good indication of where you'll need to be. 35% of the purchase price is key. And if you don't get your purchase, 65% borrowing of your purchase price, it might be the vacant possession value, then you might need to put more deposit down. The other thing you've got to be considerate of, the commercial space is very vibrant in terms of loan to values. You can get up to 100% borrowing in commercial properties if you sit in certain sectors of commercial. If you are a dental practice, you're a GP, a pharmacist, the loan to values are in your favour. But if you wish to buy a property like a pizza takeaway or a pizza restaurant, the loan to values might not be so great. If it's an Indian takeaway, the loan to values might not be so great, because there's other risks that get aligned to those industries. Unfortunately, because there's fire, there's reputable demand. There might be too many on sale at the moment at auction houses, so they might not like them. But if it's an ex-bank building, you might get a lot more borrowing just simply because of where they're located. But if you're buying a dental practice, the loan to values might be higher. So there's two ways of looking at it. Are you buying it as a trading business, or are you buying it in an investment business? So you've got to be considerate of that. In terms of time, I said 20% longer than what a buy-to-let mortgage application will take. And I think 20% more longer in terms of time, that would be right. If you put it in days and weeks, if you're purchasing a residential property in a limited company, door to door, so get it from a decision in principle to having the keys, I would say it's about 6 to 8 weeks in current climate. If it's a commercial investment or a commercial trading business that you're buying, I would go from anything from 8 to 12 weeks from door to door. So there's a lot more stringent due diligence done on the commercial arena. I think it's just simply because of the nature of commercial at the moment. It's very topical at the moment. There's lots of changes in the commercial arena around PD, planning, whether it's primary or secondary parades. The demand for that type of commercial asset, is it still viable? Do we need, I hate to say it, I dare say it, but an accountancy practice, do we need one there? Especially if you're going to buy a commercial asset and you want to trade from there, is there demand for that? Now, you're a professional in your own route, right? And I think, yes, there is certainly a demand. But do we need 7 grocery stores on the same parade, which are 100 metres wide?
Wow.
Maybe not, so there's lots of conversation. But the beauty is that, I think I said it earlier in the video, there's lots and lots of lenders in the arena. So we've got a great variety to choose from, as well as attract. And what I would say is they're hungry for business. We get called by banks every single day to say, can we help? What have you got? Can you send it over to us? Let's have a look at a deal. And what I would say is, I'm going to quickly touch on it. The beauty about contacting a broker rather than you going direct to a bank is simply because we can have these conversations with we can have the conversation with the organ grinder, the guy that's going to write the check, or the lady that might write that check. So that's key. So we talk to them about the experience of the borrower, the goals, what the property looks like, what their targets look like, and then we puzzle it all together. And then it's basically, it's that old school traditional banking, like I'll give you my word. But they are obviously going to be caveats. It's always going to be subject to valuation. The marketability and the resaleability, that's always going to be there.
You've covered so much there, Kieran. Really appreciate it. One thing I was going to touch: accountancy practices. Are they at 70%? Or
You'd probably get a tad higher, to be honest with you.
You reckon?
Yeah, you would get a tad higher.
What do you reckon?
Don't hold me to it, but you'd be close to 80% for an accountancy practice.
Wow.
But as long as there's strong, as long as the business is obviously solvent, and it's got strong accounts, and they can evidence that. So that's key. It goes down to the longevity of the business, and where you are in that town. So you want to be primary or virtually primary stationed, not at the back of the alley at the back.
I think it's changing though around a lot of accounting practice. It depends on what kind of model you've got. If it's high volume, or you're looking at different type of high value clients, and that's why registered offices tend to work. I think one of the things that really you explained to the audience was that the timing. So if I go and buy a property, say £1 million, I'm probably, and will put an offer in and they accept, they're not probably going to want to wait 3 months before they get all their money. You're probably going to have to do something in between, aren't you? Is that how normally most commercial transactions work? It
happens a lot, and it happens actually in the residential space, because that's where the volume of business is in our industry. But what we do is like, for example, if you were the borrower tomorrow, we'll just remain in contact, one with the estate agent. You'd start some legal work, we'd start the mortgage application. So as long as everyone's in dialogue and the vendor knows that we've started the initiation, we've started the finance application, the solicitor's been appointed, we're going out for quotes for the surveying work. As long as the ball is rolling, I think everyone should remain happy, and everyone just wants to remain in the loop. And we have these conversations with the estate agents all the time. And unfortunately, I wish that we could produce a mortgage offer within a day or two. And sometimes it does happen, usually if it's a straightforward purchase. And it does happen if the lender's doing a desktop valuation. That does happen. But unfortunately, you can't do a desktop valuation on a commercial investment asset, let alone a trading asset. There has to be a physical surveyor that goes out there, just because of the type of property that you're acquiring, and it's commercial. It might be multi-layered, it could be on a busy high street, it could be food outlets on either side, or it could be a club across the road. So there's lots of variants to go by. But what I would say, it's a market that is still very, very strong. From an inquiry-led basis, we're seeing a lot more influx of inquiries for commercial property, albeit through permitted development, change of use, or through planning. But it goes to show people want to diversify, or create other property income buckets and diversify into commercial. So it's I would certainly say it's a good space to be in.
Yeah, I think it's hugely tax advantageous, and I think that's what the big difference is compared to residential, which has got a lot of pressures. And I think one of the other things is FRI leases. People like to have hands-off investments, so I think that's going to drive it. I think that's been a lot of information there, and I'm just putting in my head, I think that's covered a lot. So we covered why commercial property, what kind of financing you're going to need, what time it takes from when you initially buy the property to the time that you or make the offer to the time that you may exchange deals, and what you have to think about. Also, why you need a commercial broker. Also, obviously the tax side, where you should be coming by anyway. So now we're covering a whole spectrum, and the difference is why you don't just go to the bank down the road and try to do some vanilla, because it's likely most of the time it won't be correct for you. I think we covered loads of stuff. Akil, is there any other stuff, Akil, that you feel on top of the commercial property? I know Akil we can get so much info, we'll probably spend another video's worth, but I think this is set up for another video. But this, I think, for commercial property, I think it's covered that, and a common issue of LLPs.
I think we touched on quite a few bases. All I would say is have the conversations early. If you're looking to get into something, whether you're buying something for £100,000 or £1 million, it's still your money, and you want to invest in the right manner. But remain open and be honest with your advisors, and you know, don't be frightened to pick up the phone, give us a call, because what we're here for is relationship building, and we don't want you to get it wrong. So you know, get in touch.
Perfect. I will put Kil's details in the post so you'll be able to see who you can contact on that. And I really appreciate Kil coming down to have this chat with us and give us unbelievable value and insight. So guys, ladies, definitely watch that. Thank you, Kil.
Welcome. Thanks, Z.
Cheers. Bye.
Cheers. Bye.